There, everybody. My name is Amy Bonus, and we're going to get started in just a couple of minutes. Welcome to our webinar today, which we are really excited about. Good morning. Yes, it is. It is a beautiful day outside today. Beautiful,
I always say I woke up. That was the best part of the day.
right? And you got to open two eyes,
I
right?
wouldn't go that. I wouldn't go that far. I think one is still trying to open.
Really? It's 12 o'clock, dude.
I know.
Okay, everybody, we are going to get started. And anybody that joins us later, we're going to send you guys a copy of the PowerPoint today. And you are welcome to also set up a time to chat with us and go over any details of this. It's a very unique time in the market right now. You have a lot of people that want to buy a property. People have been for the last couple of years concerned about their monthly payments. There is a lot of talk on the street right now about the Fed raising rates. Rates on average, across the country for the time that we have been measuring interest rates, somewhere the average is somewhere around 7.5. The only time that rates go down in America or in most countries in the world is when the country is in trouble and the country is in a recession. We are not in a recession right now. We probably everybody on this call feels like things just keep costing more money. Everything costs more, and that is called inflation. So when there's inflation, in order to counterbalance that, the Fed has to raise rates. And so the talk on the street is more about raising rates in the next year than rates coming down. Now, as there is inflation in the market, what happens is that typically when that happens, real estate values go up because everything costs more. And so that's a very interesting time, is that as rates get higher, so do property values. And so if you wait to buy a house until until interest rates go down, essentially property values at that time are going down, and then you missed all that appreciation. Does anybody on the call remember, or do you have any historical remembrance of what the interest rates were? You can put this in the chat, Chris, and you can reach out what people are saying in the 1980s. Does anybody remember what rates were in the 1980s?
Bethany says 18%? Question mark.
Pretty close, 18, 19, 17, 20%. So they were very high. That was a very high inflationary time. And so interest rates probably won't ever drop down into the 2% range again, unless the country is in, another great recession, right? We were in a great recession when interest rates dropped down. And so we want to talk with you today about what we have found really smart strategic buyers doing in this market to get a better deal on the house. Okay. So we're going to go over like 7 essential like strategies for you to be aware of. And then we're going to shoot you over this PowerPoint. And then if you want to set up a time to chat with Chris or I or us with your buyer's agent, we can absolutely do that. Okay. And so people are getting seller concessions. People are getting the seller to pay for a temporary buy down. They're buying, they're deciding not to buy, a $900,000 house. Instead, they're going to buy a $700,000 house, or maybe they're using the down payment assistance to help them lower their loan amount down or reduce their cash to close. Maybe they're targeting homes that have been on the market for a while so that instead of paying $450 for the house, they're paying $425, which saves them money. And of course, a very critical component is that you're very strategic in your plan, in your approach. You're looking at this as an investment, and that you do use a buyer's agent who represents your side of the coin, instead of going directly to the listing agent whose, fiduciary responsibility, at least initially, is to the seller of the property. Of course, any agent can represent both of you at the same time, but it's nice if you have your own buyer's agent to help you strategize and get the best deal that you can on the house. And that person typically will be representing you, not you and the seller, right? So if we look back, during, I guess, maybe to the height of the market, people were crazy back in 2021. There were multiple offers, Chris, on the property. Give me an idea, Chris, my right-hand person right here, my team captain on our team. Remember some of the crazy, Chris, earnest money and due diligence money that clients would put? Like, give an example of what people were putting down.
Any given time, a home would have multiple buyers putting in bids, and they were trying to outdo each other, and they would go 10,000, 20,000. I saw one at $50,000 earnest money. It was absolutely insane. Everybody was trying to get their contract accepted. It was nuts.
I saw people bid 50,000 easy over the ask price. I saw one buyer put down $100,000 in due diligence. That means that if they walked away, the seller kept their 100,000. I saw people buying properties without even seeing the property,
It
right?
was great to be a seller.
Yeah, and it was brutal to be a first-time buyer. You really couldn't buy then because, you couldn't compete with a $50,000 due diligence. That's a lot of money. So now we see that there is a little bit more inventory on the market. Sellers are much more willing to give you seller concessions, pay your closing costs, help you with rate buy downs. There's less competition. And we see that people are overall happier because they feel like they're getting a better deal on the house. And so we feel like they're getting a better deal on the house too, because they actually have time to negotiate and see the property rather than just buy the house without seeing it. That's hard to do. People think that the thing that determines the payment more than anything is the interest rate. And the interest rate obviously is part of it. But what you pay for the house, how much you're putting down, what your credit score is, affects your payment. And it affects your payment in more than one way because it could affect what you're paying on your insurance as well. If you don't have really excellent credit scores, that could make your insurance higher, right? But you also have the taxes and the insurance. When you're buying within city limits, the taxes can be more. When you're buying in an area farther away from a fire station, that could affect your insurance. If you're buying a property that's had a claim on it before, like recently in the last 3 years, that can also affect your insurance, affects your payment on that property. So it's not just your interest rate, right? It's all these things. Sometimes people are not doing 30-year fixed rate loans right now. They're doing 2-1 buy downs, which we're going to mention here today. And I have a customer right now that I spoke with this morning, and if they do a 2-1 buy down on this property that they're buying, the loan amount's about 615,000. They're saving $800 a month for the first year. So it's significant, the possibility of a 2-1 buy down. Now, the very first strategy, we're going to go through 7 today, is to get the seller to give you money. Okay. Well, I mean, even the Bible says, ask and you shall receive, right? If you don't ask, they're not going to be like, hey, Shakira, let me give you 10K here. I mean, they're not going to be like, hey, Jennifer, it's no problem. I know that we asked 525 for the house, but hey, for you, we'll give it to you for 520. I mean, you have to ask. And so if you are in a position and you're not up against other offers and you're being cooperative and your agent can court a little bit the listing agent and they work together, getting seller concessions happens about 67% of the time right now. So if you get $10,000 in seller concessions, I'm going to show you, if you pay less money for the house, that doesn't really affect your payment as much as using the seller concessions to do a 2-1 buy down. So it's pretty interesting. You can use the $10,000 or whatever you get in concessions to help you buy the house, but maybe you don't have enough money, and that is the only way that you can buy the house. This is often the case. People make a lot of money, but they don't have a lot of money. They've paid off student loans, they've paid off debt, they've worked really hard to be in a situation where they could buy, but they just don't have all the cash. So they use the cash to help them come in with enough funds so that they can purchase and stop paying their landlord's mortgage, right? Strategy number 2, we're going to spend a little bit of time on this. It's called the 2-1 buy down. Chris, I'm going to let you read the bullets here.
I love this program. The 2-1 seller buy down, essentially what it does is it gives you 2% less interest rate on the first year than market rate. On the second year, it's 1% less than the market rate. And then on years 3 on, it returns to the normal market rate. It's not a variable rate program, guys. Right. It just gives you this flexibility in having much lower interest for those first 2 years to try to get through that higher interest rate hump.
Right. And so, Chris, what happens within that couple years is like, if your rate is not going to revert to the market rate until year number 3, today is 2026. What is happening, friends, at the end of 2028? What is a major event that's happening in November? Tell me. The election. Okay. And so there will be a new president. There will be a new era. And so will interest rates go down? We don't know, but it's more likely then than now. Okay. So if you have a 2-1 buy down, it buys your rate lower for the first 2 years. And it doesn't happen until year number 3 that the rate would revert to the regular rate. And you know what that's going to be. So here we have a real client. We have real clients here. They're not just fake clients. This couple bought a 425 property. They got the seller to give them $10,000 and they got a much better deal on their mortgage. And this is how it looked. They got 2 points less the first year. They got 1 point less, like Chris said, year number 2. The seller pays for this. You, the buyer, cannot pay for it. The seller must pay for it. You cannot do a temporary buy down. As a buyer, you cannot purchase this program. Okay. The seller is paying for it for you. And so let's say you bought a 425 house and that you put down 5%. This is what your monthly payment would be at this rate. I'm not saying this is the rate today. I'm just saying at this rate, this is what your monthly payment would be. Okay. So let's just make a note of that. $2,668. That's just your principal and interest payment. All right. We got that. We wrote that down. Okay. Instead, let's say instead of paying $425 for the house, friends, you said, no, no, no. I don't want the temporary buy down, Amy. I just want to pay less for the house. Okay. Seems like a reasonable request. Your payment goes from 2668 down to 2605. You save $63 per month by reducing the price of the house $10,000. Okay. Now, if you guys have a pad, go ahead and write that down. Okay. If you pay $425 for the property, your payment is $2668. If you pay $415 for the same property, your payment is $2605. Okay. Now, this is what happens when you do a 2-1 buy down. Instead of using the $10,000 to get a better price, you can use the $10,000 to buy down your interest rate. Okay. And when you buy down your interest rate, look at what happens to your payment. So is that payment a lot less than the $10,000 less in price, right? It's a lot less, and it's $512 less per month. Okay. So here is year number one. You're getting 2% lower rate. Your payment drops $512 for the first year. Year number two, it's still significantly less. It's $2406 per month instead of $2668. And then year number three, it reverts to a regular payment. Okay. And hopefully by year number three or year number 3.5, you're going to be refinancing. Chris, do you want to add anything to this?
Yeah, as a matter of fact, I closed a borrower that we did the 2-1 seller paid buy down, and they decided they were going to make the full payment. For example, this 2668, and the additional funds they applied towards the principal, and so they got some principal reduction.
Oh, that's
Um,
huge.
yeah, and they couldn't do it all the time, and they wanted to have that flexibility. But it was a great tool to them to actually lower their total financing cost.
Yeah, Daryl, we know that you just came into the workshop, so we're going to send you the first few minutes of it so that you can hear what we were talking about, the 7 different strategies. This is strategy number 2, to use the money to uh, do a 2-1 buy down. And I'll just back up for a second. I don't want to put everybody behind, but if you instead get $10,000 less on the purchase price, your payment is 2605 instead of 2668. And so it's a better deal for people to get the buy down because the buy down essentially lowers your payment a lot more than the reduction in the purchase price. So, Chris, are there any questions in the chat that you want to address?
Yes, Geeter, if I'm pronouncing that right. Getter. In what situations is a
Jeter.
2-1 Jeter? Thank you, Derek. Yeah, the baseball guy.
Yeah.
All right. In what situations is a 2-1 buy down attractive to sellers, and how does it help them close a deal? Part 2 question, why would a seller agree to a 2-1 buy down instead of lowering the sales price? And part 3 is, what financial or strategic benefits does a seller gain by offering a 2-1 interest rate buy down? Good questions.
Well, people offer a 2-1 buy down or agree to give you funds to close to sell their house. So that's a pretty simple answer. They haven't sold their house. It's been on the market. Nobody's made an offer on it. And you ask them to pay $10,000. They can either turn you down or they can sell their house by the time that you've asked them that, since the house has not been on the market for 2 hours, instead it's been on the market for several weeks, they want to sell their house. So their financial gain is that they get to sell their house. Whether you use the money for closing costs or for a 2-1 buy down or for reducing the price, they still get $10,000 less money. So, or $5,000 or whatever it is that you're asking. Chris, was there another part of that question that I missed? I know there was 3 parts.
Yeah, and I can probably expand upon that. If you're offering monies for a 2-1 seller paid buy down, then and you have a $300,000 purchase price compared to your neighbor who's selling his house and he's not offering a 2-1 buy down or funds for a 2-1 buy down, the monthly payments are going to be significantly less for the seller that is offering it, meaning lower monthly payments, lower interest paid. And buyers right now are super sensitive about interest rates and monthly payments because things are getting more expensive. So if you did a side by side on your neighbor versus your house that has the 2-1 buy down, they reduced their price by 10 grand, or you gave them 10 grand for the seller paid buy down, then you'll come out probably with a sale compared to your neighbor. That's you're just offering something better for the same price point.
So
Are you,
people offer buy downs and people offer seller credits in closing costs so that they can sell their house. They haven't sold their house, and rather than not sell their house, they're giving you a concession. And 2 out of 3 sellers are offering and paying concessions right now. Concessions could be inspection repairs. They could be a lower price. They could be money towards closing costs. They could be appliances. There are 2 out of 3 sellers statistically right now in North Carolina are giving seller concessions. And it's happening a lot on equally on existing homes versus new homes. The third strategy is, instead of you looking at a $600,000 house, maybe if you want to lower your payment, you don't buy a $600,000 house. You buy a $400,000 house, or maybe instead of a 450 house, you limit it to 425. In this case, if you're going from a 450 property to a 425 property, you might be saving close to $160 per month. People have in their mind a certain figure that they can afford or not afford, right? Because you have other things like a flat tire and you have to pay your utilities, and you have gas or your electric bill for your EV or insurance or food, so people have budgets that they work within, and um, you want to live by that budget, although you don't want to buy a house just because it's really inexpensive, because if it's in disrepair, then you're going to have a lot of issues with disrepair. Yes, some builders do offer money for a 2-1 buy down on new construction. We also do have 2-1 buy downs on all different types of loans, like VA loans. Our company is VA owned, veteran owned and operated. So we do a lot of government lending. You can do them on FHA loans. You can do them on conventional loans. You cannot combine them with down payment assistance, but you can do them on all different types of loan, whether it's new or existing. So strategy number 3 is you buy a little bit less house. So you don't buy the Mercedes car. Instead, you buy, a different car because you don't need that car right now. And a lot of people, what they do, friends, is they want to build a real estate portfolio because more money has been made in real estate than all other industries combined. So how can you build a real estate portfolio? Well, you could buy a house, you can move into it, you could live there a few years, and instead of selling it, you could then rent it and go buy yourself a new primary residence. This is a strategy that works in building a real estate portfolio. Because if you want to buy an investment property, you're typically putting down 25, 30% of the purchase price to buy an investment property. If you're buying a primary residence, you don't have to put near that much down and you get a better interest rate than an investment property. So you don't have to buy like the house of your dreams, maybe this time. Maybe this time you're buying a house that you're going to live in for a year or two or three, and then your intention is to keep that as a rental property. So that's strategy number 3, buy slightly less house. Strategy number 4 is, hey, I'm going to try to get the best interest rate that I can. And what is a major thing that affects your interest rate is your credit score. This is why our team spends so much time pre-approving people months before they buy a property, because we want you to find a path to yes. We want you to find a way to buy real estate and stop paying your landlord's mortgage. So if we know that you have a 677 credit score, we're going to do everything that we can to make sure that that credit score is as high as possible so that your mortgage insurance premium is lower, that your interest rate is lower. And working on your credit, we can help you do that. We do that all the time. And just to show you, you guys paying your credit on time is only 35% of your score. People think it's like 70% of your score. It's 35% of your score. I mean, that's still a lot, but 30% of your credit score is based on your limit. My credit card limit is $1,000, but I owe $990. Now you have a high limit to balance ratio. And those high limit to balance ratios negatively affect your credit score and make your credit score go down. So when Chris and I approve you, we may say to you, hey, if you just pay that one credit card down to like 30% of the limit, then your credit score is going to jump up. And since you're not buying for 60 or 90 days, you have time to do that. Because friends, once you make a change in your credit, Chris, how long can it take to affect your score?
Uh, 60, 90 days.
Right. Weeks. So
Yeah.
like if you're closing next week and you pay down your credit card, will that help us, Chris? No. I
No,
mean,
no, we're not in constant credit monitoring. We pull one credit report and we call it a day during that transaction. We don't continually monitor the credit. So
but even if we did, your credit score is not going to go up for 8 weeks.
takes a little bit.
So
Yeah.
yeah. So if you did it today and then you paid down, $100,000 worth of debt, it potentially could not show up until September. But you're closing in August, so then you don't get the benefit. That's why we encourage you to get pre-approved 3 or 4 or 5 or even 6 months ahead of when you want to purchase. Because it gives us time to put you in the best light for the underwriters. Okay. Okay, so strategy number 5 we'll get to. So here's a question, a poll question. If you guys can put it in the chat. Which of these concerns is is making you nervous about buying in today's market? The interest rates, not having enough down payment, B, just write in the chat like A, B, C, D, E. I don't know where to start. Home prices keep increasing. That's D. Or affording the monthly payment, C. What is most important? Just pick one. And then Chris, you can just tell us the anonymously, what
Yeah.
people are saying.
And we got C is one.
Mhm.
Next one is C. I would imagine that would probably be semi-universal across the board. Things are getting more
Affording the
expensive.
monthly payment, which is
Yeah.
exactly what we're talking about, which is why a 2-1 buy down is a good way to go. And certainly you guys can see that. Now, strategy number 5 is we do a ton of these, and a lot of lenders do not do these programs because lenders make half the money that they would normally make on a regular loan on these types of programs, and they have a lot more work to do. Okay, so they get paid a lot less and they have to do more work. So that's why a lot of builders don't offer these programs. That's why a lot of lenders do not share these programs with you guys. But we love these programs. And we come from very humble backgrounds. We were, I mean, I know when I was a kid, like we struggled with money a lot. So I'm very fond of like taking advantage of programs because nobody ever told me about this when I bought my first house. And I really got upset because I qualified for some of these programs when I first bought my first property. So one of them is this awesome down payment assistance program from the state of North Carolina, where if you are, number one, a first time buyer, number two, you make less than the maximum income for a family of 3 in Wake County. What do we have, Chris? 153, I think?
Yeah, I think it's
152?
153, 152.
And it's 153, I think, and then 132 for a family of 2. So it's quite up there. You have to make less than the maximum income. Number 3, you must be a first-time buyer. We have to prove that by showing on your tax returns that you are not a homeowner. I mean, not a primary homeowner. Unbelievably, you could actually own an investment property and still get this money. And then you also have to buy the new sales price, Chris. You told me the other day it's gone up above 500 now, right?
Yeah, I think it's sitting right around the 528 mark,
Yeah.
but it's
So,
definitely higher than it was last year.
I mean, it's unbelievable. I remember when it was 300,000. So, you just have to, we just have to pre-approve you and you can get this money. And this could solve a lot of problems because you may only need $5,000 to buy your first house. And on these programs, you're getting a below market 30-year fixed rate loan and you're not paying a whole bunch of discount points to get it. So the down payment assistance programs, if you qualify, like, why not? You only get it one time, the first time that you buy your primary residence, right? Strategy number 6. This is like if you want to put a star next to this and also getting seller concessions, um, you need to target the right houses. It's really simple. Okay. If you're targeting a house that just got put on the market today, 2 hours ago, they're not really likely to give you a really great deal on a property that just came on the market. This is, I'm going to show you in the next slide what the homes are that if you target them, you have a much better chance of getting a good deal on a home. Like if the home is on the market for 30 plus days, or if a home has, outdated piece of crap carpeting in there, or the floors have to be redone. It's a great opportunity for you to do your own thing and get this sweat equity. Whereas if they redid it, maybe it would cost 20,000 more to buy, but by you doing it and you paying $6,000, you can get $20,000 worth of equity in the property. So homes with minor cosmetic issues, if the seller has left and the house is vacant, rock on. Good for you. Because you have a better chance of negotiating in in a situation like that. Or the home has been on the market and the price has been recently reduced. What a bummer, man. I just reduced my house, but now somebody's going to come in and make a lower price offer than I just reduced it to. Give me a break, this seller says. but they want so much to sell their house that just maybe if you're reasonable, I don't mean offering 50,000 less, but you might get them down another 5,000, who knows? Or unfortunately, if somebody is going through a divorce. Now, normally people don't like advertise this, but you might see signs of it in the house. The listing agent may tell your agent, or if a home was under contract and now it's come back on the market, maybe that buyer's loan approval fell through. Who knows? They probably weren't pre-approved. Who knows what happened? But homes that come back on the market, the sellers are much more likely to negotiate. So you don't want the hottest listing. Does that make sense to everybody? So you want to target the right properties. This is like this and the 2-1 buy down are like double stars for you. Double stars. Number 7, you want to have, Chris, if you want to elaborate on this, maybe explain what does a buyer's agent do?
Well, a buyer's agent is going to represent you versus a listing or seller's agent. It represents the sellers, and their best interests are the sellers on the listing side. So you really want to have a buyer's agent that is going to negotiate on your behalf, try to get those deals. If you go make an offer with a listing agent, and assuming they're a dual agent or they want to be a dual agent, they may not give you as much perks or as much a better offer than if you had your own buyer's agent. Again, the listing agent, they represent the listing, or they represent the sellers. The listing agent does, and so get yourself a buyer's agent. And typically that is paid for by not so much anymore, it just depends, but it's paid for by the seller and the listing side, your buyer's agent's fees. But you have to talk to your agent on that, and it's usually home specific. If you're looking at a house they're offering no
Yeah,
buyer's agent fees,
90% of the
then
time you see it paid by the
yeah.
seller. And you just have to be aware that some people do not. But it's not common. So those are the 7 strategies. I'd like to open up the floor for questions. Make sure, people, that when you in life, you want to have a win-win. Like, you don't want to beat somebody down. It's not good karma. It's win-win. Okay. Like, can you be flexible on the close date for the seller? Can you reduce the seller's risk by being really approved? Because when we pre-approve you, you're actually approved. Like, we've verified all the stuff, right? I mean, you may not have all the cash to close, but we know what your plan is. So it's a real approval. That's makes it safer for the seller to accept your lower price offer because they know that it's a real approval, especially from us. It will help you to get your offer accepted versus a big bank that's not in America. Another thing is people that you could offer a rent back to the sellers for a week or so to make a transition to move to their new property. Or don't say to them like, I'll buy your house if you change like the kitchen counters. And also I need you to paint this and I need you to do it. It's not going to set a good tone. Just make a nice clean offer with as few contingencies or buts to make it easier for them to accept your offer and take you seriously. Yeah. That's just be reasonable. Like treat people the way you would want to be treated, and they respect that, and it makes them more amenable to help you get what you want, right? And so maybe everybody will get more of sort of what they want. If you decide to wait to buy a property when interest rates go down, what happens to the number of people that come to buy properties, you guys? Like, how do buyers, when interest rates go down, are there more buyers in the market or less?
More.
Exactly. There's more buyers. And so if there's more buyers, there's more competition. And if there's more competition, the purchase price goes up. So, okay, I want to buy a house now. It's 425, but I think maybe interest rates will go up. Maybe they'll go down. I'll just wait a year. If you wait a year, it really doesn't matter if interest rates go down or not. Purchase prices in general in North Carolina are going up. If they go up a tiny amount, 4 or 5%, the house cost more. So you just lost $25,000 in purchase price on this, on approximately in this situation anyway. You also paid approximately in Raleigh $2,000 a month to rent here. Easy. Okay. So you just paid $24,000 to your landlord. So you lost $24,000 in rent or whatever you paid in rent. Plus you lost the appreciation. Plus you lost the principal reduction, $5,000 over the course of the year. You could potentially lose $40,000, $50,000 in a year by waiting. So people don't really understand this, but there's less competition now than there could be if rates are lower. Okay, so I just wanted to bring that up to you. As a repeat client, we do a no lender fee refinance as long as you've been paying your mortgage payment on time, because we incentivize you to come back to us to do the refi. So if rates drop or when rates drop in the future, we will refinance you with no lender fees. Okay. Chris, I think somebody just put a question in the chat.
Yeah. Would it be recommended to use equity in your current home to purchase a new home and rent out the original home, or just sell the first home before buying new?
If you could afford to keep the home, Jeter, then that's what I would do.
Shakira.
But, oh, Shakira, I'm sorry. Shakira, if you could afford to keep the home, then keep it. If you can't afford to keep it because you don't have a down payment, you can't figure that part out, or you don't qualify with both of those payments, or you haven't rented it yet, then we'll sort of help you figure that out in the pre-approval process. So there's not like one answer fits all, because it's based on sort of like your income and debt ratios and your cash and sort of all that. So I don't
Depends on
know.
the scenario and comfort
Yeah.
factor.
I'm not sure if that helped answer your question or just frustrated you, but hopefully if when we talk to you on your pre-approval, we can address that with you on your situation, okay? Chris, we have about 2 minutes before we end our webinar. Just see if there's any questions in the chat. The pre-approval is, a place where we determine sort of the maximum that you want to qualify for. Maybe it's, not 425, it's 500, but we pre-approve you for a little bit more to give you some room. And maybe we also at that time give you a path to yes or ways to make yourself look better so that we can get you a better deal on the mortgage. If you're doing a 2-1 buy down, you absolutely want to know before you put an offer on the property, because it is part of your offer and it allows you to make a shopping, like an experience where you're like, I am, shopping with confidence, which will help you get a better deal on the property. Again, you want to get pre-approved several months prior. We would be happy to pre-approve you and help you on this journey. Make sure that you're using a local lender versus a big bank, because the listing agents here in the South really like people that they can go knock on their door. They don't like calling big banks because they get the runaround. So they're more apt to accept a local lender's approval than a large bank. Also, we did mention to you, we do see people purchasing a little bit less homes. They're using leverage, Shakira, like as you mentioned, they're using the concept of not putting large down payments down and so on. They're using seller concessions. and they are not putting large down payments down if they can swing the payments. So these are the trends that we are seeing. Before we end today, I just wanted to let you guys know of our upcoming webinars. Like this is on the books right now on our website, but again, I'll send this over to you. And just before we close for today, I want to thank you for being on this call. We appreciate you sharing your energy and just open up the floor for questions, which Chris, I'll let you navigate.
All right.
Thank you,
You're
Tinsley.
welcome.
Well, thank you guys. Feel free to email us if you have any questions or call us. I know Chris and I will be calling everybody in the next 24 hours, and we are here for you, and we are absolutely here for you to go through the scenarios of the 2-1 buy down. It's a really good deal, people. I hope you guys have a great day. Thank you, everybody.